Rainy days and Mondays may always get you down. I know, I date myself, but count on Tuesdays to get you up if you're a stock market investor. Today was the 18th consecutive Tuesday. The Dow has gained, this time finishing at yet another all-time high. All but 4 of the Dow 30 finished higher today, led by Bank of America, up nearly 3%. Contributing to those gains, greater optimism about the economy from a small business group, and then encouraging words about stocks from David Tepper, co-founder and owner of the hedge fund Appaloosa Management. Here's why he and a growing chorus of investors are bullish on stocks.
The economy's getting better. Autos are better. Housing's better. It continues to improve. They can't find enough people to work, and housing is the only thing holding it back right now. We have years to run an early stage economy. We don't have inflation. You have capacity utilization is low, so you have room there. Labor unemployment's high, so you have room there. There's no inflation on the horizon, so we have a little bit of room to run.
And a run they did today. The blue chip Dow rose 123 points, closing at that new record of 15,215. The Nasdaq added 23 points, and the S&P 500 was up 16, also reaching a record close, with 75 of its constituent companies posting all-time highs today.
Joining us now with his take on where the market goes from here, Sean Darby. He's Global Head of Equity Strategy at Jefferies. Sean, let me add to the numbers of statistics that Tyler just mentioned. 178 days that the S&P has been up without anything more than a 5% correction. So does this mean that it's time for a correction, or maybe not?
Well, the equity market breadth has been superb, and that really represents the fact that there's been ongoing buying power across the board of the stocks in the US. And ironically, the stocks that have been favored the most by investors have been very defensive. So defensive markets by their nature don't necessarily correct that much. And really what I think we're starting to see now in the equity market is quite a rotation into more real economy issues as people become much more confident about the next 12 months in the US. So I suspect we'll continue to make new highs, and that will grind higher as people capitulate into much more riskier parts of the economy.
Sean, I was speaking earlier today to Andrew Sliman of JP Morgan, and he mentioned that he thinks that the dividend stock trade has gotten very crowded as investors have poured money into that particular category of the market. Do you agree with that?
Well, I do. Unfortunately, the evidence that we see from the fixed income market is that that trend can go on for a lot longer. And last week, for example, we saw a very, over 7 billion going into fixed income and credit into the US, which is a 2.5-year high. So unfortunately, I do agree with the statement, but the trend is likely still to be into that area until rates start to move up. But I think that the overall tone really for the US in the next 12 months is real economy beneficiaries, and particularly stocks benefiting from a domestic backdrop rather than international growth.
You know, I want to get back to this correction or a pullback, because a lot of people are bracing for that other shoe to drop. What would be the trigger? I mean, what are the warning signs?
Well, I think the warning sign would be higher bond yields in the US. I think we're starting to see that certainly in Japan, which is now recognizing that the BOJ's policies have been very aggressive and that they're beginning to be worried about inflation. And I think that certainly if the US started to see any inflation picking up, or indeed much better job growth numbers, the backup or the push up in bond yields in the US would start to hurt the market gains in equity. But I still think that will probably be more of a 2014 story rather than over the next couple of months.
Tell me quickly how you see the balance of supply and demand in the equity market. We've had a lot of stock buybacks out there and money in the form of the Federal Reserve and elsewhere coming into the market. Does that force prices higher, all things else being equal?
Well, I think it does, and I think we've been doing quite a bit of work on this over the last 12 months, and the share buybacks have also been accompanied by a very, very scarce amount of new equity issuance. So this money's been forced into equities, it's been forced into very, very defensive areas where the people have been chasing yield, and now, of course, that people have to rotate into much more sort of riskier parts. And of course, unfortunately, the supply has been shrinking at the same time. So it's all been a very, very strong pulse for the equity market, and I think we'll still be seeing gains going into towards the end of the year.
Well, that's a very upbeat way to end this conversation. Thanks so much, Sean. Sean Darby of Jefferies and Company.